This is what matters, getting more people working. When you see the unemployment rate, that variable can also go down because of the size of the labor force. So the problem with that is that if you've got a group of people who've been out of work for a long time and looking for a job and decide to quit looking because, hey, I'm not finding anything, then what happens? The size of the labor force actually shrinks. When the size of the labor force shrinks, the unemployment rate goes down. All right? So the unemployment rate, while it is a good indicator of where things are, it is a lagging indicator of economic activity. And it's not as important to look at as actual job growth. And so we can see here, this is perhaps a better way to look at it, total South Carolina employment. You can see how in 2009 it started increasing, and it's beginning to increase at a slow rate. This is critically important for the future of the housing market in South Carolina. Now, what feeds employment in part? Well, population. And it turns out that population in South Carolina has not changed appreciably in the last 10 years or so. So you can see the percent change on the right. We've been increasing anywhere from 1 to 2% in our population growth rate on an annual basis. And this hasn't really fluctuated much in the wake of any type of economic shock or any type of external shock. So that's been relatively constant. What has changed, however, is if we look at it on a market-to-market basis, on a county-to-county basis. Here's an example. What this graph shows you, and you'll have to take my word on this one because I know you're not going to be able to see this in the back, but these lines are shades of blue and shades of red. And shades of blue imply that people are in-migrating to South Carolina. Shades of red means they're moving out. In Lexington County, and this also shows the counties throughout the nation where they're moving to or that they're moving from. And it turns out that in most counties in South Carolina, there is an influx of population. All right, so eventually, we're going to create jobs for these people. And as they come into Lexington, you can see that. You can see that they're coming in Richland. And let's take a look at Charleston. All right, so huge influx of population. Now, this is very positive. Of course, we have Boeing coming to the area. And part of this is due to that fact. Now, if you look at Saluda County, on the other hand, they have a net out-migration. So they're having fewer people coming in than are leaving. And of course, they're not very, they don't have a lot of movement going on there because they're a rural county. But this gives you some idea. Population, as population grows, those folks get jobs, those folks then need housing. All right, so it all ties together, even though employment is our single best indicator there. All right, so what's up with foreclosures? Is there a reason to be optimistic about that? And again, the answer is yes. And numbers play tricks on you. Statistics, you can lie with statistics. Everybody's heard that before, right? So foreclosures are up 133% in Charleston. This is 100% true. Now, it's not the whole story. What does that mean? Well, that means that as a percentage of the total housing stock in Charleston, the number of foreclosed homes has gone up from 0.03% to 0.07%. Right? So that's a 133% increase. But in terms of absolute numbers, it's very small. So when you look at percent increases, especially in regards to foreclosures, sometimes I think these figures are stated a little bit more, stated more highly than they really are, or framed more highly than they actually are. So what this is, to put it in perspective, is that for every 128 houses that sold in Charleston, what other home somewhere in the area went into foreclosure? Right? Still not a good number, but better than what we were probably aware of and the information that we're probably fed. In South Carolina, that rate is about 73 to 1. So then what about price appreciation? If foreclosures aren't quite as bad as maybe they're painted to be, then what is it that's driving price appreciation? Well, as I said, I think a lot of the low demand is created by the uncertainty that we have in the market. And I'm convinced that market expectations are critically important. That if you, and you hear consumer confidence index, I didn't bring that graph with me today, but there are two sources of that, and it's quoted frequently in the media. Consumer confidence is up, consumer confidence is down. That's critically important both in business and in a consumer market. It's like I said before, if you're concerned that you're not going to have a job in 6 months, you're not going to go out and buy. If you've had a great day at the office You're going to go out, take your spouse to dinner, you're going to go out and buy a new DVD, buy a Nintendo Wii, go out and spend. But if you've had a bad day, if you're concerned about the future, you're going to save your money. So confidence is critically important. It's important in the business world as well. Because if you look today, and again, anecdotally, I talked to folks who are in charge of hiring and making hiring decisions saying that they are seeing pickups in business activity, which is great. But they're very concerned about hiring workers because they're not convinced that this is going to last long term. Again, that's not to say that it won't, but it's their perception that matters. Because if they're seeing an expansion of output and they want to increase the number of employees, and they're reluctant to do that, that's going to create or prevent job growth from occurring as fast as they otherwise could, which will have spillover effects to the housing market. So can you kind of see how confidence and stability is critically important when we're talking about in any recovery? Secondly, high levels of inventory. We're still suffering from high levels of inventory. There's no doubt about that. And that is contributing to price appreciation. More so than foreclosures. One of the questions that I get about foreclosures is specifically how much do they impact depreciation in house prices? So in other words, foreclosures by themselves are a problem. How much do they contribute to the depreciation? And the answer is, I just showed you. And then those FHFA figures, they look at house over house sales over time. So that takes into account foreclosures. It takes into account short sales. So I can't tell you what percentage of house price depreciation, so we saw that 3% in South Carolina. I can't tell you what percentage of that is due to foreclosures, but I can tell you that 3% does take into account foreclosures. Okay, so that's very important as well. Okay, so one other statistic I want to show you is what's known as the employment to permanent ratio. And you can see that it's increasing in Columbia, in Greenville, and in Charleston. And there are a lot of fluctuations here. And actually some new numbers came out this week that show it ticking upward again. But the important thing is to look at the overall trend here. So this is employment divided by permits. So it's a relative measure of housing demand. Again, our single best indicator of housing demand is employment over housing permits. So an indicator of future supply. So when we're looking at the future market, this is very important to keep our eye on. Because what this is saying is that employment levels are rising relative to permit activity. Now, in this particular case, we're seeing the opposite because both variables in recent months have been decreasing. That's changed in 2010. But to a large extent, in 2009, what we're seeing is that employment was decreasing at a smaller rate than permit activity. But either way, the principle is the same. It's increasing. So overall employment relative to permit activity is increasing. This is very good news because this means we're getting a pent-up demand for housing. It's going to have to be realized in the long term. So eventually, what this means is that housing demand is going to go up. Right? So this is true in all markets in South Carolina. The P ratio is increasing. So this is something that you can look at and something that you can track on a regular basis to see how we're seeing future demand, pent-up demand coming in the future. Okay, so the bottom line, what's the take-home message from today? First is that in terms of the national economy, the growth of private investment is extremely important to establishing long-term and long-run economic growth. It's going to be sustainable and it's going to keep us out of this recession and get us on to economic prosperity again. We're finally seeing that in 2010. It's forecasted to continue to increase for the remainder of 2010. And this is very critical to long-term growth. Secondly, tax credit expiration will lead to lower sales activity as the market adjusts, but will be partially offset by the improving economy. So again, we have to look at the next 2 to 3 months. So, and again, when I say the next 2 to 3 months, there's a lag time because there's an average of 45 to 60 day period where we go from a contract to a closing. And that varies. It's actually longer now because the tax credit, while it expired on April 30th, that was to put a contract on a house. That wasn't to close. To close is later on in the fall. And so that's going to drag out this process going from contract to closing. So that's going to make this lag time a little bit longer than it might otherwise have been. Okay? But the key here then is that this will be partially offset by an improving new long-run equilibrium. It's a short-term fluctuation as the market adjusts to the fact that we borrowed sales from the future. Third, the housing market suffering from poor expectations and low consumer confidence.